People use banks for different purposes. Some have extra money to save. Others need to borrow. Some need to manage their household finances. Others need to manage a business. Banks help those customers meet those needs by offering a variety of accounts. A checking account probably will be your first type of bank account. Checking accounts are a safe and convenient way for you to deposit money and withdraw funds as you wish. You can withdraw funds electronically using an ATM machine. With a checking account, you can use personal checks or swipe a debit card to make purchases or pay bills. Some checking accounts pay interest. The interest rate often depends on how large the balance is in your account. Some checking accounts charge a monthly service fee if the account balance falls below a preset limit. Do your research. Compare the services offered by various banks. Opening your checking account is the first step to learning how to handle and manage money. It is also your first step to establish your credit history. Saving accounts allow you to keep your money in a safe place while it earns a small amount of interest each month. These accounts usually require either a low minimal balance or may require no minimal balance at all. This depends on the financial institution and the type of account. Putting your money in a savings account will earn you interest on the amount of money deposited into the account. However, the interest rate is usually low. It is also safe because it is FDIC insured. An advantage of having money in a savings account is that you have liquidity. That is, you can access your money anytime you want. Be sure you understand all the privileges of the savings account. Some offer check writing against the account, and others allow debit cards as well. A money market account is similar to a basic savings account in that you make deposits and earn interest. However, there are some restrictions to earning a higher interest of money on a money market account than on a savings account. You must maintain a high minimal balance and are limited to the number of withdrawals. For example, you may be required to maintain a minimal balance of $1,000 and have no more than 3 transactions on a month. This makes the money market account less liquid than a savings account. Money markets are insured by the FDIC, making them a very safe investment. A certificate of deposit, or CD, is a time deposit offered to the consumer by most financial institutions. Certificate of deposits require a specific amount of deposit for a specific amount of time. The interest rate is fixed, remaining the same for the length of the investment. Depositors face a penalty for early withdrawal of the money from the CD. This type of account is also FDIC insured up to $250,000. One thing to note, higher interest rates are paid on larger sums of money and on longer periods of time. Deciding where to put your money will depend on several factors. What are your financial goals? How much interest you will earn? How you plan to use the money? How much money you have at the time of opening the account? Which type of account is most liquid, that is, can be easily withdrawn if needed? Before you make your decision, once again, do your homework. Research and ask questions. Handling money is a big financial responsibility. The choice is yours.